Hello everyone and welcome back. In this video, I want to go over a few topics that I haven't discussed yet, like the details of the loan, which bank I went to, and the type of loan it is. I'll also review some of the risks of borrowing money to invest and how I prepared for those. Plus, I'll give an update on the state of the loan. Finally, I'll end the video with a viewer question that I want to share my thoughts on. And please don't forget, if you find this video interesting, hit that like button. It really does a lot to push this video to more people who are interested in the same content. Okay, let's get into it. For the loan, I went with TD Canada Trust. I already had my mortgage with TD for the last 5 years, but when it was time to refinance, I did shop around, compare prices, and after some back and forth with around 5 or 6 banks, TD offered me the lowest interest rate. So when I was refinancing my mortgage with TD, I also opened a home equity line of credit, HELOC for short. For those of you who don't know what that is, a HELOC is a revolving source of funds, much like a credit card, that you can access whenever you need to. It uses the equity in your house, that is the difference between your home's value and your mortgage balance, as collateral. Since the loan is secured against the equity value of your home, HELOCs offer extremely low interest rates. Compared to unsecured borrowing sources like credit cards, you'll be paying a lot less interest for the same loan amount. I also went with a variable rate. If you're unfamiliar, there are two main types of interest rates, variable and fixed. A fixed rate loan has the same interest rate for the entirety of the borrowing period, while variable rate loans have an interest rate that can change over time. In general, variable rate loans have lower interest rates and can be used for affordable short-term financing. Borrowers who prefer predictable payments generally prefer fixed rate loans, which won't change in costs. I went with variable to keep the interest payments low. So that is the type of loan I have, a home equity line of credit with a variable interest rate of 2.95%. Since I knew that I would be averaging around 7% return on my investments, I'll be making more than double my interest payments. If I couldn't get that low an interest rate, I might have not been able to move forward with this plan. Having that amount of cushion helps mitigate the risk. Speaking of, let's discuss some of the risks with leveraging money to invest. There are 7 risks I would like to talk about. First risk is companies cutting dividends. I've mitigated this risk by choosing stocks that pay me a higher yield than what I pay in interest. Currently, I'm receiving an average return of 7% while I'm paying 3% on my bank loan, leaving me with a 4% average that can be cut before I'm in trouble. While I can't say it's impossible for all 6 companies to cut their dividends to the point where the yield will be lower than 4%, this is unlikely to happen based on their past dividend payments, their forecasted business revenue and growth, and what we've seen during the past few recessions. Second risk is going out of business. There's a reason why I didn't pick startup companies whose stocks could shoot up by the hundreds of percent in a matter of months, or companies who have recently had their initial public offering with the potential to skyrocket. Those kinds of investments are risky, and unless you know the fine details of the business, it really is more of a gamble than investing. I have chosen businesses that not only have been around longer than I have, except TELUS, but half of them have been around for over 150 years. The risk of one of these businesses going under is very minimal. Third is a falling stock price. This is one risk that I'm not concerned about at all. For one, until I actually want to sell the stock, its price is irrelevant to me. In the short term, prices go up and down all the time, but ultimately good companies always end up in the same place, up. For these next 2 risks, I personally have not had experience with them, so I called TD and asked them about it. Those risks are having a loan called in. Depending on the term of your loan, it's possible for the lender to ask you to pay it back earlier than expected. But a HELOC isn't a loan. There is no calling it in. So that's one less risk I need to worry about. But if you use another method of getting money, just know that that's a risk. Another is a bank raising interest rates. Now, not all interest rates are created equal. Mortgage rates are different than loan interest rates, which are different than HELOC interest rates. So while this can happen, I've never seen my HELOC or mortgage rates change. I'll have to wait and see if this does happen and to what extent. If my interest rate does rise, that's fine, but it'll eat into my 4% profit. The next risk is investing lots of money multiplies gains, but also amplifies losses. Let's say you have 10 shares of any company and the price of that stock goes down $1. You'll be down $10. Nothing to panic about, right? That's the price of a McDonald's combo meal. So you've lost $10. Now imagine instead of 10 shares, you have 450. Now when that price falls $1, you're down $450. That's a lot of combo meals. And some people can't handle seeing that. I've never invested with this much money before, but I'm confident I could handle the stress of seeing the prices fall in the short term. Speaking of stress, unfortunately, this one is more about the person you are more than anything else. Sure, you could be more informed with how the market behaves so that nothing unexpected happens. But if you're just the type of person who loses $20 at blackjack and wants to quit for the night, you probably shouldn't be investing. So, those are 7 risks of using leverage to invest. I'm mostly concerned with 1 and 5. Out of these 7, those 2 are most likely to hurt this investment strategy. And I hope both don't happen at the same time. Fingers crossed. Now I want to give a little update on what's been happening with my loan. It's only been 3 months since I took the money out, and you can see here that in those few months, I've been charged a total of $317 in interest. But I've also received dividend payments totaling $828. So as of today, my loan is sitting at $64,488. That's down $511. In a couple of months, I've made $511 in passive income. Now I understand that it's only been a few months and there's plenty of time for something to go wrong. So for now, I'll leave it at so far so good. Everything is on track and going as planned. Now let's take a look at my position. And yeah, this isn't good to see. Seeing my stocks in red, especially Enbridge, down $1,550. It's not nice. There's no other way to say it except it's not nice.
That's not nice! Not nice!
You're right, baby Luca. It's not nice. But I keep reminding myself that the stock price doesn't matter at this point. The loss is only realized when I sell, and I don't plan to do that anytime soon. Enbridge is a solid company that is still making money and paying out a dividend. Nothing has changed. This does not equal this. The stock price falling doesn't equal the dividend being cut. And this is exactly what I mean in the third risk I discussed earlier. People see the stock price fall and they want to sell out of fear that it may fall even more. But if you're investing in a solid company, don't worry about the price falling. It will bounce back, and until then, enjoy those dividends. Before I end this video, I had someone ask me a very good question that I'd like to share my thoughts on. IC1101 asks, given your stock choices and desire for monthly payments, why not just purchase an ETF like ZWC? First of all, thank you for asking in the comments. This is a really good question. What you're suggesting is a good idea, and probably safer than what I'm doing. ZWC is an ETF from the Bank of Montreal with similar holdings and a higher yield of 8.57%. So why didn't I choose that? Well, for 2 reasons. Let's start off with what I think is the biggest advantage I have over an ETF like this: growth. Because I'm investing in the companies myself, the growth potential of each stock is greater. This ETF first started 3 years ago, and since then, to March 2020, the price on average is about $18. XTR, my first ETF, has stayed around $11 for the past 10 years. The ETFs I've seen don't grow very much, but likewise, they don't lose much value when it does fall. Obviously, there are exceptions to this, but I haven't tracked or invested in those exceptions, and I can only speak to my own experience. I personally feel like ETFs are ideal for beginners, those who are not interested in monitoring stocks, or those who can't handle the stress of investing in individual companies. In the case of ZWC, one reason for the limited growth is because they used covered calls. What this means is that they sell the right for others to buy part of their holdings at a particular price. Let's say, for example, I have a share worth $100. Then for $10, I sell you the right to buy that share for $110 by the end of the year. If the stock price falls to $90, then you wouldn't purchase the share. I've made 10% on my investment and I still own the share. Easy money, right? Well, yes, if the market falls. But let's say the price goes up to $150 and you exercise your right to buy that share for $110. Now, I made 10% because I sold you the right. It's still easy money. But you made 25% because you were able to buy that share at a lower price. Both parties made money, but I only made 10%, whereas if I didn't use covered calls, I would have made 50%. That's a very simplified explanation on what covered calls are. So while ZWC is safer, because of covered calls, its growth is limited relative to individual stocks. And again, that's not to say it would have been a bad decision to put all my money in that ETF, but it will take me over 10 years to pay my loan off using only dividends. That's a lot of time for my stocks to grow, and I don't want to restrict that growth within an ETF. The second advantage is small but worth pointing out. Any ETF has a management fee ranging from 0.3% to 1%. I'm sure some could go higher, but that's probably a good average. I understand that's not a lot, but when the difference between my yield and the interest is only 4%, a 1% management fee eats into that profit, and it eats into how much I could pay to the principal of my loan. So I would prefer to invest in companies myself and save the management fee. Okay, I think that's it for today. Thank you to everyone who's made it this far into the video. Remember to hit that like button, I'd appreciate it very much and it helps others find this video. And hit the subscribe button so you'll get notified when I post another video updating everyone on my progress. Thank you all for watching, and take care.
See, I got free to fight. Was it my makeup? You had blood, right? I got things to fight.